Menon, CEO PGIM India MF, G. Pradeep Kumar, CEO Union AMC, and Sandeep Sikka, Executive Director and CEO Nippon Life India Asset Management. And to moderate the panel, Mahalakshmi, I would like to invite you back on stage.
Hi, this is going to be an interesting panel, very different from the previous panel. And taking off from where Kezad left, we'll take off from there. And there were very interesting points that came out in that discussion also from Radhika and Neil Parekh. You guys were not there, where they talked about their strategy, challenges, and opportunity for new fund houses. Again, I think before coming here this morning, I just looked up the top 20 mutual fund houses in the United States, and let me read out the names, okay? Vanguard on top, BlackRock, Fidelity, Capital Group, Amundi, Wellington, Invesco, Franklin, T. Rowe Price, Geode, Blackstone, Schroeder, DWS, Legg Mason, Brookfield, and many more. How many of them are in India? 2 or 3, maybe 4. What does this tell us about the mutual fund opportunity in India? And that's really a genuine question I have, because you look at any industry in India, over the last few years, there has been so much clamor for, big companies to come to India because of the demographics, because of, whatever market that we offer. Mutual fund industry is perhaps one of the very few industries, I can't even think of the second one, where foreign investors have come in and they have gone out. Most of them who started off here have also sold out their businesses, and one man out here has helped them sell out also. But there seems to be more optimism amongst the domestic guys. Now, NJ is, of course, on this panel, the newest fund house. There are more coming, Zerodha, Samir Arora. Of course, for him, it is just a homecoming. But there is more optimism amongst the local guys compared to the big daddies, who should ideally have the time and patience and capital and everything that it takes to establish the business out here. So what are we getting wrong out here? I'll ask the big daddy Sandeep Sikka first.
So I think, firstly, let me congratulate Moneycontrol for this great event. I think the theme that I was seeing, the 100 trillion, is very interesting and coincides with a very interesting another number. I think we're at a very interesting juncture where first time in India, every Indian is investing 100 rupee per month in SIP. I think we've achieved this feat, after a long time, and this is happening with only 3% of the population investing in mutual funds. Now just think of this 100 naturally will become 200 or 300, because as the income levels go up, and 3% of population investing in mutual funds will go to 6% or 10%. So I think we're looking at a scenario where industry is going to do well. And secondly, I think the way I see, especially after hearing Sonu Sood, just what struck me, I think we talked about a lot of work that he's doing for the society. This industry also, I think every person associated with this industry should thank the investors, because when somebody trusts with their money, it's a very big thing. And today, the 5 crore investors are investing this in trusting this industry. So let me now come to your question. I think I've been in the industry I've been with the company for 20 years.
Right.
And so it's very interesting. In these 20 years, the number of players have almost remained the same. We've had roughly between 40 to 45 players. We have seen about 20 exits. Exits, sold out, M&A. We participated in it, we have acquired. However, this question keeps coming up. I remember when I was the AMFI chairman, at that point of time, 2 foreign asset managers went out of the country, and this question came to me from some friend in media like you. Do the policies in India help the Indian asset management companies? And at that point of time, I mentioned there's nothing called Indian asset manager, new asset manager, old asset manager. This business is very simple business, and the most difficult thing to do in a simple business is to execute. And I think if anyone who's been able to execute it well has been able to scale it up. And from our perspective, the way we see things is, I think it's not about foreign asset managers. A lot of names that you took, 20 years back, all the mutual funds which started were new mutual funds. Many of those were foreign names. Some survived, some did not survive. Some domestic names were there, which some survived, some did not survive. But I think when I look back, the biggest differentiation between the companies which survived and did well was they were able to find the niche for themselves. They knew what they wanted to do rather than being a mass player and do multiple things. For us, for when I see myself, in 20 years, I see 21 into 20. Every year we have to relook at the strategy. And to be successful in India, it's very important to be very nimble feet. You have to change your strategy. For us, let's take, I think, in Gujarat, 3 cities of Gujarat, we have different strategies. Investors in Rajkot are very different from investors in Baroda to investors in Gandhinagar. Now, if you don't have different strategies for them, I think you are bound to fail. A lot of foreign asset managers, the marketing was decided in Hong Kong, the fund management was done out of London, and the strategy was done from Boston. And it doesn't work like that. So to give a long answer to a short question, the opportunity is big. The key lies in execution, and anyone who could execute has been able to be successful.
That's a very interesting thing you said, that the investor in Rajkot and Baroda and Gandhinagar are different. I would want that insight so that we can grow money control also better in these cities. But that apart, Rajiv, you are the newest player in the industry. Of course, you have something very interesting to leverage on, which is the NJ distribution, which you have done. But that apart, was that the only factor, or was there anything bigger that motivated you to get into this business, especially looking at, how the stock markets are treating asset management companies these days, and generally to see the return profiles of these companies, I mean, the big companies coming down? What led to that optimism?
Okay, so we are new to the mutual fund industry, not to asset management. We've been in the asset management space for about more than a decade now as portfolio managers, and we are among the largest in the country. So we had that background. We've done only factor-based investing through this period of time, and we've put in the effort that is required to to build up the capacity for that, including databases and including our skill set. So you require a very different set of skills to manage money based on data. So we've done that effort, and our optimism was driven more by the fact was that there was no one who was doing it in a dedicated manner, and we believe that this is something that we wanted to take to the retail investors. So the optimism that came, it's not just an opportunity, it's not just a niche for us, it's something that we believe in very, very strongly. And we believe that this is where, I'm not saying that it's going to be, it's us versus the rest. I'm saying it is a complementary strategy which does not exist in a substantial way in this country, and we wanted to bring it to the masses. So that's number one. So having our own distribution business, which is what it looks like from the outside, let me just tell you that, to all the people here, they obviously know that NJ as a distribution business is not, like any other distributor. It comprises of thousands of partners who make their own decisions whether they want to sell a product or not. So it's not as if someone in NJ can tell somebody that now you go out and sell this product now. It's not like any other, formal distributor. It's a very, very open system. Everyone decides, 20, 25,000 active partners. They decide who they want to support, who they don't want to support. So, though that is a huge benefit.
Is this like the Swiggy having their own kitchen versus other restaurants on that thing? There is a lot of skepticism with which you view Swiggy's kitchen when you see that restaurants are logged onto the platform.
Well,
I'm sorry, I had to ask that.
No, not really, because it's an open platform, right? So we are allowed to have our own product, right? And if people prefer to sell that product, so be it. Sometimes they may, sometimes they may not. I mean, it's not as if they're beholden to sellers. It's not as if they're obligated to sellers. There's no such obligation across the organization. So it's not as if we are entitled to the support. Like every other participant in the industry, we have to earn it. So that's the second part of it. The third part of it, and coming to your first question, what are we missing out? What are we doing wrong as an industry? When you say so many foreigners have come and gone, not many people are coming in, the top 20 are not here. Let's look at this industry, you're talking about 100 trillion. I think it's going to happen in less than a decade. That's my belief. I think the mutual fund industry is growing at a pace which is incredibly high. It's going to grow at a pace which is, much, much higher than what you've experienced so far. Okay, because there's, when we talk about compounding, the human brain comprehends compounding in a certain way. So we say our economy is going to grow at a nominal rate of 12%, so every 6 years it will double. That's something that we can absorb. But when we say in 15 years' time, it's going to be 8 times, okay, that suddenly comes as a shock to people. Like, how can it be 8 times? It's only double in 6 years. How can it be 8 times in 15? So stuff like that happens. But when you're looking at exponential compounding, which is what we are going to experience, right? Our economy is growing at 12%. An economy which is growing at 12% at $2,000 per capita GDP, when the next $500 comes, the savings rate is going to be much higher. Of that savings rate, financial savings are going to be much higher. Of those financial savings, mutual funds are going to be much higher. So there's a rate of growth that is becoming exponential, and we will grow at a pace which no one can imagine. So to me, the question is not what are we doing wrong. The question is that why are they getting it wrong? Why can't they see the opportunity?
My question is, what is it that you see that they don't see? Because
this is what I see, which I don't know why they don't see it. Because if they would see it, they would be here in droves. We've had 60 participants today. I don't see why they don't see it. And what Sandeep said was absolutely right. Execution is key. Cost control is key. It's a difficult market to be in. It's a market where you need to count the pennies. As a CEO, okay, what I do control 100% is my cost. I have no control over where the markets are headed. I have no control whether people will like my product or whether they won't like. I'll make all my efforts to it. But I have no control over it. I have no control over the outcome. I do have control over my costs. And if I can focus on that and at least focus half my time on one side of my P&L, right, and focus half my time on the other side, creating that opportunity for myself, creating that space for myself, I think that is where most of the big guys, most of the foreigners who came in, I think that's where they faltered. Their costs were ridiculous.
So what are you gunning for? A product-centric approach which gives you an edge over the others, which you will build on at some, as you go along? Is that the bet?
Given the outlook that we have, it's not about an edge over the others. So that we're very, very clear on. Because there's enough opportunity for everybody and more. We hope more people come in. It's not a product-centric approach.
That's also a good tack to take when you come, when your parent is the distributor.
No, but I think, the entire industry will vouch for it, that I don't think anyone of, the industry participants who work with NGA have felt as if there is a favor that is happening. So I think the industry would vouch for it, right? Also, we are not looking at a product-centric approach. We're looking at a philosophy-centric approach. We believe in factor investing. We believe that it is, important that investors in India have a participant which dedicates itself to creating the capacity, to creating the skill sets that are required to optimize, the investing based on factors. And that is the opportunity that we see. The market opportunity is there for everyone to see. That's not unique to us. And my only problem is that, if foreigners don't see it, if the foreign participants don't see it, then honestly, I think they're the ones who are getting it wrong, not us.
Fair enough.
I think Sandeep wants to add something.
Well, I think, again, I'll just add, I think it's very important. It's not about product, it's not about distribution. I think this industry offers so much opportunity. And I have always believed it's very important to identify what not to do. I think what a lot of players, especially, the domestic or international who exited or closed the shop, was they wanted to be everything to everybody. So I think, what Rajiv talked about factor. So I go back in 2016, we acquired a company wherein we started ETF business.
Yeah.
A lot of my colleagues from the industry at that point of time called me and said, I think it's the biggest blunder I'm doing in my career because we live in a world, we are tuned and mentally, we are made to believe alpha is everything, what you were asking in the earlier panel. Yeah. I think as a CEO of a company, you have to believe that I think we are here for the investor, let the investor make that choice. And was ETF at that point of time, does it make less money? Answer is 100% yes. But we are not the ones to decide. I think we have to keep the investor in the center and let him decide whether he goes for active or passive. And every person in the industry, I can tell you, since morning you have met, because this industry was built on the backdrop of alpha. It's very difficult to believe that that thought process has to be disrupted. So I think the point I'm trying to make is we'll have to everybody, even if we are an established pair after 20 years, we keep pinching ourselves and say, what is going to disrupt us? And there are so many opportunities in India. I think the worst thing you can do that you say, I want to do everything. So I think that to the point, whether it's a product differentiation, channel differentiation, something you'll have to do. Otherwise, I think you'll get lost. And I think you'll be again history.
Sure. Pradeep, let me get you in here. So when you think about your company, the way you've thought about your company, did you think about differentiation? Did you think, I mean, what are the factors that you really think about, given the fact that you are a late entrant into this industry? And it's not just in mutual funds. Anywhere you are a late entrant, you have to be different to ensure that a challenger has always to demonstrate differentiation to be able to disrupt something. So what was the thinking, and what has been your journey so far?
Our journey has had two chapters, or completely two different parts to it. So when we started as a joint venture with a European company, we faced some of the problems that you alluded to earlier, right? What is it that the foreign guys get wrong? And we had this experience of, a classic case of how wrong you can get with execution, right? So we had a company which had a model where in Europe, their mutual fund products were sold only through their own bank, right? And it works brilliantly for them. They had a 40% market share in that country. So they thought, why not do this in India? So, they tied up with a public sector bank, large public sector bank in India, and said that, yeah, you do this in India, you sell only through this public sector bank, right? I don't have to tell you, what happened with that strategy. So that was one part of it. But there is a very interesting learning also there. Right from day one, we were very clear. I told everybody that we are not trying to eat into anybody else's business. This ocean is so vast that there is enough for everyone to grow. So with the network that was available to us, which was the Union Bank network, we managed to add a significant number of new investors. On an average, I would tell you in those years, about 65 to 70% of our investors were first-time investors in mutual funds, right? Which I consider to be a very good achievement. It just shows, what can be done if you can reach out to more people. Our bank was not a very sophisticated seller of mutual funds. They were just like any other public sector bank. But the point is, they were able to reach out, right? So to give you a perspective, if I took, particularly a couple of years back, the top 10 cities in terms of number of investors for us, some of the cities that would figure: Varanasi, Gorakhpur, Jaunpur, Azamgarh. I had more business from Varanasi than from Ahmedabad, right? So it just shows that if you have the reach, you can really get more and more investors into the industry. And we managed to add a lot of new investors, which is why today, while our market share in terms of AUM is minuscule, we have a full 1% market share in terms of number of unique investors in the industry, right? So if with our size and our limited resources, we were able to achieve this, I think, there is tremendous scope to expand. So our strategy, going back to your original question, we were very focused on adding more investors, reaching out to places where others were not there. So that worked very well, which is how we survived those years. The next part of the journey, after our foreign partner pulled out and we had another partner, and we became open architecture, and then the challenges were very different. Then we are competing in a sense with everybody else in the market, and we had different challenges. So one thing which we wanted to be known was, rather than differentiating ourselves on the basis of products, because see, honestly, there is no copyright. Anything that you do, even before you launch your product, somebody else can copy if it's a good idea. So we wanted to be process-centric. We said the only thing, to borrow from Rajiv, see, we focus on what is in our control. What was in our control was the process. See, I can't guarantee what will be our rank, what will be our returns, etc. Nobody knows. We run as fast as we can. But, we said we will tell you how we select stocks, how we create portfolios, how we manage risk, and what exactly we are trying to achieve. So, for example, our fund managers are not incentivized to be in Q1. We say consistently be in Q2 or Q1. Q1 and Q2 have equal weightage. So nobody has that incentive to take extra risk or achieve anything in the short term. So we said we will stand for that. Now how that works, I'll just give you an example. Okay, in March 2020, we launched our mid-cap fund. And as described in the earlier panel, that was a very difficult time for the market. Market was falling. And our process was that we will not try to time the market, right? We will not stay in cash. All our equity funds at all points of time will be fully invested. If you want us to take cash calls, asset allocation calls, come to asset allocation products like BAF, right? So in an NFO, the day we get the money for investment, 1 or 2 days, we'll deploy the whole money. People got really nervous. They said, in this market, are you going to deploy 100% of funds, that to mid-cap? We said, that's our process, and we will do that. Now, as it turns out, the first day when we had the money to invest was 23rd March 2020. Right? 23rd March and 24th March, we deployed the whole money. Now, did we know that was the bottom of the market? We had no clue. We knew that this is what we were supposed to do. Okay, if we are expected to be consistently above average, we have to be in the market. You can't be consistently above average by taking cash calls. So this is what we said we will be known for, right? Entire last year, we were probably the only one or maybe one of the very few AMCs who did not launch any NFO. We said market is expensive. Our view is that it's very expensive. So we will not launch NFO, right? So now it comes at a cost, right? There is a cost of missing business. But we said, let us be known for this. There are so many things that we lack, like a brand, size, reach, marketing budget, all that we lack. But this is a long-term journey. Asset management is not a short-term game. So if you want to build a reputation and a name for yourself, we said, let's do it, the way we work, the process that we adopt, and hopefully it will show results and we'll be known for that. So that has been our approach.
Fair enough. I have one or two related questions on what you said, but before that, Ajit.
So Mahalakshmi, first I'll start with a correction that PGIM is the 10th largest asset manager in the world, and we are here. When you look at daily NAV, products all across the world, we are the 10th largest. And we've, been committed through the journey, despite the crises that we have been through in the past. It's a 145-year-old brand, of course, but in India, the journey is about just, 10 or 12 years old. And I think that, for us, while as a team now I can look back at the crisis and say we steered ourselves pretty well, I think the question that you ask, which is that, can you really differentiate? I think you can. I did hear Navneet in the earlier panel talk about the fact that you sometimes don't necessarily need to differentiate on the product. You can differentiate in your communication. And you can differentiate on facilities that you have and the service that you have. So for us, I think some of the guiding things that we've been doing to differentiate ourselves is, I think that we try to be better storytellers. I think where we come from is that...
That's the job of media. Don't put us out of business.
Well, you can come to us for some good stories. But, there's a nuance here. Yes, the world is run by stories, but it's run by authentic stories. It is run by stories that feel genuine. It is run by stories that are backed up by evidence and facts as well. So we don't try to tell the story from an entertaining perspective, but it is about thinking about the science underlying our industry and our business. I think that today, a large portion of most stakeholders are stuck in 1952, when Harry Markowitz wrote his portfolio theory paper. And then you had, Eugene Fama and you had William Sharpe writing about capital pricing models. We think about man as an economic man making rational choices if you put all the numbers in front of him. And then came the Daniel Kahnemans and the Richard Thalers and the Meir Statmans to tell you that, listen, it's not the numbers. Yeah. It is behavior. It is behavioral biases, it's feelings that matter when people take money decisions. I think at PGIM India, what we've probably managed to do a little better than average is to connect the dots on how can we build sustainable behavior, starting with within the company, of building trust, of being transparent to build that trust, of thinking through with the customer in the center, as Sandeep was saying, on many of how we construct the stories on, for instance, as Pradeep mentioned, we believe as a multinational that process is at the heart of everything. But to translate that process into a story that can be told within less than a minute, because the attention span of the general human being is, evidence to be less than a goldfish at 8 seconds. So how do you can't get market share if you can't get mind share. And mind share comes from the stories which are genuine and authentic. I think we've managed to, do that as part of how we've built ourselves so far. We do think that every industry goes through 3 phases. The first phase is when distribution is king. The second phase is when investors gain more awareness and the product becomes king. And the third phase is when the product becomes commoditized, when the brand becomes king. We went through the first phase where the only discussions we did were commissions or foreign trips.
Right.
Try and sell our products and ideas. That happened, I think we made awareness a big part across the country, and then the product became king. For me, that product that became king is SIP. There are people who say, "Maine SIP kiya, mutual fund nahi," and they don't realize it's become that strong. 2018, SEBI's done this categorization and rationalization, as you call it, and the product has now become a commodity, which means brand is king. I think that every small AMC can, whether you are an advisor or a mutual fund or a wealth manager, I don't think size matters if you really got the ambition and the execution and the talent on your side.
Sure. So 2 points, execution, then differentiation not only through products, and you talked about onboarding first-time investors through a unique channel, a bank channel. So that's the question I wanted to really veer to, because that brings us to the larger question of viability of business. Because it's one thing to say that, of course, you said you're proud of the fact that you have 1% share of unit holders, which is quite an accomplishment for a new player. But at what cost? Because acquiring small accounts into tier 2, tier 3 cities is a costly business. It requires patience, time, capital at a time when, fees structures are not as they were earlier. So in terms of viability, how do you think about it?
I think I can answer this in very short. So this will be this year, 2023, FY 2023, I think for the 5th year in a row, we will be making profits. At an AUM, which we have just crossed 10,000 crores, we are profitable. So it's doable. Now, you just need to see what works for us may not work for somebody else. Everybody needs to find, the niche where, where they can make a difference and where they can be sort of, more efficient. For us, it really helped the fact that, we had a bank network with us, which was able to reach, forget B30, B100 kind of places where, we were the only player, right? So conversations were easier. And I have challenged people very often, in various informal forums. Give me a genuine investor, somebody who has actually got money to invest. I am willing to bet that I can convert that person and get her to invest in mutual funds. Because we have a fantastic product, right? Mutual funds is great. It's a question of, can you have more conversations? Can you reach out to more people, right? We managed to reach out to more people in a cost-efficient way, right? So it worked. So we sold simple products. So I'll tell you about, the product part. So some of the things that we have consciously stayed away. We have never launched a sector fund, right? Because we believe the kind of audience that we have is not really ready for sector funds. Because, see, we all, with all due respect to all the players, I'm telling you what works for us, what we did. See, we all launch typically sector funds when the sector story is very hot and it will work for some time. But nobody goes and tells the investor that, the story is over now after whatever, 1 year or 2 years, now you move out. This conversation never happens, and we have seen this with IT funds, pharma funds, infra funds, N number of times we have seen finally investors leaving funds with disappointment. See, why I say disappointment? Because for an investor, in my view, what really matters ultimately is the day she sells, what is she getting? Your historic NAV, outperformance and all doesn't matter. When you redeem, what are you getting is a question. And very often people end up redeeming at the wrong time and go with a poor experience. So for that reason, given our audience, we thought we can't handle this. So we didn't launch sector funds, right? Unless we can find a theme or a sector which is sustainable in the long term, we will not do it. So I think some of these calls need to be taken because it may come at the cost of business. Now, if we had launched some of the sector funds, maybe we would have raised more money. But that's a call we had to take. So yeah, I think, smaller investors, onboarding them, it takes effort, need not be expensive. You just need to, find your own strengths. What works for me may not be what works for Ajit.
Fair enough. What is the golden AUM for viability? He said he's already making profits, but in terms of return on capital, you've grown Nippon from where to where?
So I think broadly, let's first let me say the revenues and the profitability of the asset management companies will be under pressure. I think it will come on three accounts. A, investor not willing to pay so much, regulatory, or competition. On all the three. Now, which is going to happen first, which is going to be second, we don't know. But which leads us to the point it's very important to have a very light structure because the structures of past may not work. The second most important thing is, many times the business models are built. I think this industry also has one thing which is good and I feel not so good. We only talk about AUM. I mean, even your punchline talks about 100 trillion. I think somehow, we need to move away from this to the number of investors. I think next time, you, Kazad, when you do the next year event, you have this thing that every Indian household is a mutual fund investors and the topic for the 30 crore investors. I think that's the way. And why I say this is, that is going to, many times when we see the profitability of AMC, it is also dependent on what type of investors you have. Now, the retail investors give you stability. I remember when we launched the first SIP of 100 rupees, people said, I think it's not viable. But when we had 30 lakh investors investing, even if it's 100 rupees, it does not matter. So I think to this point, industry is going to be under pressure. I think if the revenue is concerned, the point that I see is going to be, I would say, I don't want to let everybody on his own, but if you want a scalable business, I think a 20,000 crores AUM is something that you look at that is sustainable. But one thing that is very important, we talked about the unit holder, we talked about the returns, we talked about everything. There's another aspect that we forget. There is also a shareholder. And why your question on profitability is very, very critical. The long-term interest of the shareholder to continue in India or to continue the business and not to sell the business is also dependent on how much return on equity that shareholder is making. Correct. And so your question is also, there's a third angle to it. So the profitability is definitely under pressure and scale is the only solution to that.
Sure. Scale is the only solution to that. How far do you see yourself running in the next 5 years?
See, like coming back to, focus on what's in our control. Okay. So, and there are three things that we, believe that we can control and we can manage very well is, number one, focus on costs. Okay, stay as light as possible without damaging future prospects. So it's not, you're not controlling costs at the cost of the future. You're basically putting in place enough capacity to grow, but at the same time being very, very cognizant of the fact that you don't want to be, to build cost to a level where you will collapse under the weight. That's number one. Number two, focus on processes. Okay, we get our processes right, and that's very important for us as rule-based investors, as factor-based investors, to get our investment processes right. If we get our investment processes right, we get all our other ancillary processes right, we are bound to get it right over the long term. The short term really doesn't matter. Performance over 1 year, 3 years is again, 3 years is reasonably long, but performance over a year really doesn't count for anything. And lastly, what we believe in very, very strongly is that asset management is a boring business. It's supposed to be boring. It's supposed to be about doing the right thing unfailingly, day after day after day. anyone who tries to make this business exciting is bound to fail. That is my takeaway from it. About close to 3 decades in the industry, as long as you focus on getting it right.
Fair enough. Keep it boring.
That's
the
Keep it
mantra.
boring. Okay, just do the right thing day
Fair
after day after day, and that's what will hold you in good stead over a long period of time.
Sure. Ajit, you can have the last
So I'm,
word.
I'm sort
because
of,
you're the-
I'm sort of lucky to have a partner, a foreign partner, a large partner with deep pockets, to keep investing into the business because their view and this is something that I find very encouraging is never to ask me the question about what's happening this quarter or this year. Really,
This is what I was about to ask you, that, like Goldman Sachs, has PGM given you a target in terms of when they're going to review, whether they want to remain in India or not?
They have
Is that
resoundingly at least confirmed, even in the press, in Bloomberg and elsewhere, that they're going to be investing more into India. Fortunately, I think we've done well over the recent years to give them the confidence that we can grow organically. They are not averse to growing inorganically as well if the right opportunity presents itself. But I think when I have seen my internal discussions, and I've been at 2 multinational brands, it's always a question of relevance first. It's also a question of profit being an outcome of something that you have to first get right, which is consistent performance with a very, very good process. And for that, you need people. So the things that I've learned and coming from the multinational brands that I've worked is that this is a people's business first. You've got to get the talent right. Once you get the talent right and you've got your process right, as Pradeep was also mentioning, I think the profit outcome is reasonably sure. It may take time. For instance, we've crossed 20,000 in MFs, but we are not profitable yet. We should be maybe in the next 12 months. We will get there. So for me, the target's been of relevance. So for us, it was the target of saying, listen, if you want to be relevant, you need to at least be in the top 20 to begin with in the 3 years since we started the journey 3 years ago, and then aim for the next leg. And that can come even inorganically. Now, we had gone all the way down to 29th or 30th. We are back at 21. In 2.5 years' time. We've had fantastic support. 80% of our assets comes from MFDs. Right? We've not had national distributors or private banks pick us up at the early stage because all of them have filters and criteria for right reasons.
Right.
And now we're getting there. So we've got a long runway. I think the direction of the business as the international partner or the sponsor sees it is fantastic. So they're willing to commit further. We've got a couple of licenses, not just mutual funds to run. We've got the PMS, we've got the AIF, we've got international advisory. And all of them don't get counted in assets, but is reasonably profitable. So you have other ways of participating in the market.
Sure.
When you raise the first question about international brands having gone out of India, and I have no idea, they could all have had their own reasons, obviously, to do that. But I've also felt that in many conversations that I've had, that you don't need to be a mutual fund player for a financial brand to participate in the growth story of India. Right? You can participate in public-private partnerships with the government. There are projects. There are various ways of participating into the growth story of India. So I don't think that we can brush them off. Yes, they may not have got some of the execution right in some cases, but they have the deep pockets to come in and grow the market further, which is good for everybody. There's also an element of the evolution of our industry in terms of regulation and transparency, by the way. Transparency more important than even, of course, the regulation matters. So PGIM, we are the 4th largest in the world in real estate. It's a fact that even I didn't know till 4 years ago, and we've got a global real estate product which is innovative and differentiating in the marketplace. They have not invested into India yet. And the reason is that many of the regulations that make real estate transparent are very, very new. And they're looking at 20 years of data where they can predict occupancy rates and rental yields before they can even start. So a lot of these reasons we've done extremely well as a country. And I think all kudos to the regulator as well, that even while we think it's swung, the pendulum on regulation swung a lot and that it's hard, it's helped make everything more transparent. I was at a recent discussion, small digression on this and I'll stop, is where I had a good market specialist say, do you know what's happened with FASTag? right? What FASTag has done is it's made data on Indian roads so transparent that large pension funds are now willing to come and fund infrastructure in India, which they were not willing 5 years ago. Because the data is so transparent in terms of what's the usage of that asset, which we never had before. And there are pension funds I have heard personally talking about the fact we have the money, we can't see the project. Show us the project. So I think that there are various reasons here for multinationals. We are quite confident that the profitability will come if the input is right, which is more to do with consistent performance, risk-adjusted performance, good talent, and participating, as Sandeep said, across the spectrum to let the customer choose what he would want from us.
Fair enough. On that note, I'm getting a lot of looks from my colleagues because we've really overshot time. So on that optimistic note, you said PGIM has reaffirmed its belief and keeping patients in India. And I hope that becomes the inspiration for a lot of